What's going on?
Markets
don't want to go down.
I agree with that point, that it feels like those previous times in the last couple of years when you had one of these gentle clockwork 20% rallies off a really scary moment, which was late summer, early fall. And, it kind of has defied that typical, let's pull back and let people in kind of a thing.
Right.
So that's where we are. I mean, it also looks like February of 11. It looks like April of 11. I mean, there are times when this happens where it's going to, the trend is going to get reinforced, and I think we may well be in one of those times.
But it's interesting because the market has been, it's felt very, for people who look at the market, it's felt very solid. Felt very, you never get the, even when the headlines, you have all this, the headline risk, which last summer, whenever a headline came across the market, would sell off 1 or 2%. I think in January, the market didn't fall even one day by more than 1%. Did I get that right?
No, in fact, the market has not actually traded to a year-to-date return of a negative return so far this year. Well, that doesn't mean much, right? It went up the first day and everyone. Last year, we actually did that until mid-March.
I see.
It was only in mid-March that we actually said, okay, the year-to-date return is less than flat. So, no, I do agree with you, actually, about the sort of rhythm of the market. I like the fact that Wall Street strategists coming into the year were actually very cautious for their
they were all negative.
Have any of them, they were saying only up 70%.
Right. Well, have any of them, in particular, the fellow at Morgan Stanley was quite bearish. The guy at Goldman, David Costin, he was kind of bearish. Have they actually changed their tune yet? How long does the market have to run up before they put out a revised note?
I think you probably have to get up another 10%.
And then they'll...
but also the fundamentals of what they were saying have to really, be challenged, right? So, the guy at Morgan Stanley was perfectly right last year. He's saying this market is going to, multiple contractions is going to be the theme the entire year, right? But this year he had the same theme, so it has to happen again for that to be correct. So no, they haven't done that. Look, starting a couple of weeks ago, I was saying, all right, finally people are getting a little comfortable here. You go up for 3 months in a row without one of those pullbacks, that's what's going to happen. Right. So, I wrote this week about these, kind of stocks that never do anything but pay a dividend over the last 10 years, and maybe there's demand for that. And the fact that there's demand for that is probably more bullish than bearish.
You were talking about the J&Js, some of the staples companies, even a Microsoft,
Walmart,
for example.
Was actually the stock of the last 10 years that basically varied the least.
Walmart.
Right. And,
well, that was because it went from probably traded at one time 25 times to 27 times earnings, and now it's down around 12 times,
and all the time, there wasn't a real great bull case out there for Walmart. The biggest buyer of the stock is the company itself.
Right.
The company is essentially the family is essentially buying the stock back from the public.
Right.
The Waltons are, again, majority shareholders.
Oh, is that right?
Yeah, just barely.
So what do you, looking forward, though, let's assume that all the headline risk out of year, it won't disappear.
No,
we know
course.
that, but it's definitely kind of reached a different phase, I think. We had the good jobs report on Friday. For investors out there, you get the sense that people are waiting to buy on a dip.
Yes.
And so they're like, so on a day like today when the market should sell off 100 points, let's say, the Dow is kind of down 40, 50 points. You could easily see the thing trading up into the close and ending flat on the day. I mean, I don't want to predict what will happen, but you could see that.
Recently.
You could see that happen. People are sitting there waiting to get in.
Right.
What are brokers on Wall Street telling their clients, the ones that they put into bonds last year, that are going, geez, if these bonds aren't going anywhere?
Yeah, I think they're most likely saying, Europe. And what I find interesting, though, by the way, is the typical broker has no more fun buying a 10-year Treasury at 2% than I think any of us would, or that their clients do. But it just became this default thing because there's no such thing as a risk-free asset anywhere else in the world, even if that's risk-free. So I do think they've been trying to find kind of ways to fake it, right? To fake the income and the risk-free stuff.
Right.
And they, I think that's why arguably the absolute dividend trade is a little bit too crowded.
The thing that I find odd, and it's interesting because Google's stock today is up a couple of percent. You're starting to see kind of some of the more Apple stock is up also on a day when you're getting a lot of the traditional safer haven stocks not doing so well. You do see, though, a stock like McDonald's, some of the staple stocks, trading at these very rich multiples, and then you get these other kind of weird companies like Apple trading at very low multiples. It's kind of a weird kind of thing, isn't it?
Utilities and pure staple stocks, to me, look like their safety is being overvalued by the market right now. The perceived safety, I guess I should say. And I was saying recently, to me, if a broker came to me with an idea to buy a stock, it's got to pass the Apple test.
Right.
Is it cheaper than Apple based on this year's earnings?
Right.
And now look, Apple.
And there's almost there are very few stocks, right? Because it's trading well below the market
below
multiple.
the market multiple. Now the problem there is, and I think that it's not underappreciated risk is. There's a risk to have $100 billion in cash with nothing to do with it, earning nothing. And I think the market's kind of worried about that little piece of it.
Right.
And of course the new management.
Okay, looking forward, what should we be looking at over the next few weeks? We're halfway through earnings.
Yeah.
Earnings have generally been as forecasted, plus or minus, not blockbuster. Jobs report is better. What is going to be the next? Is it going to be Israeli lobbing a bomb into Iran?
If I had
is it going to? Is it? What should people be looking
if I
for?
had to, if I had to do the equivalent of the prop bet in the Super Bowl last night that said, "Will the first score be a safety?"
Right.
Then maybe I would have to go with something like, it's some reason oil spikes.
Right.
If you look, whenever we've had these phases in the last few years, you get up to about a 2.5–3% growth rate in the U.S. The markets have done well. They've sniffed out the fact the economy is going to be better. The economy proves it's better. You had something come along. So that something was an oil spike in the Arab Spring last year. Plus the Europe stuff, which got a lot
I got to
worse.
run. So you're looking at oil.
I'm looking at oil. I'm
Mike
looking at the fact that the
Santoli.
risk trade includes buying up crude oil.
Right.